Welcome, I'm Evan Cooper of Investment News, and in today's master class we'll be discussing what's next for exchange-traded funds. With me today are four expert panelists. They are David Mazza, Principal and Head of ETF Investment Strategies Americas for State Street Global Advisors, or SSGA. Martin Kremenstein, Head of Passive Asset Management for the Americas at Deutsche Asset and Wealth Management. Dodd Kitsley, Head of ETP Research at BlackRock. And Tony Davidow, a Vice President at Charles Schwab, where he serves as Alternative Beta and Asset Allocation Strategist at the Schwab Center for Research, which is a product-agnostic think tank researching investing trends on behalf of advisors and institutional and retail investors. Today we'll be discussing where exchange-traded funds are now, where they're going. So where are we? Where are they? Well, at the end of the first half of the year, there are almost 1,200 U.S. exchange-traded funds from 38 providers, accounting for about $1.35 trillion in assets. Throw in exchange-traded notes and other related exchange-traded products, or ETPs, and the total comes to 1,478 different investments. For information on ETF performance, asset flows, and other data points, I suggest taking a look at the data we compiled in the July 22nd issue of Investment News, or on investmentnews.com, where you'll also find information about the Investment News Alternative Investments Conference in Chicago in September, where we'll have a live and lively discussion of ETFs and their role in alternative investing. But now, let's find out where ETFs are and where they're going. Dodd, let me ask you a question that many others have been asking. After explosive growth and almost 1,200 products in the marketplace, can the expansion of the ETF market continue? What do you think?
In a word, absolutely. We think we're still in very much the beginning stages of growth. If you look back over the last 5 years, assets have more than doubled. We just finished a report forecasting growth over the next 5 years, and we firmly believe that the industry can grow to $3 to $3.5 trillion by 2017. There's a lot of catalysts behind that, but looking at just numbers of compounded annual growth rates over the last 10 years, we've been at 23%. If you assume just a 13% rate off of the asset base today and a market return, blended return of 6.5%, you're there in that $3.5 to $3 trillion range. But there's a lot of just very positive catalysts that are driving this. Most of it has to do with increased investor adoption, whether it's the advised market, the self-directed market, institutional. We're seeing just very, very positive trends, and the penetration rates are very low, so we have a huge amount of opportunity for growth. Take, for example, just the advised market in general. Cerulli just finished a survey, and they show that 98% of financial advisors intend to increase or maintain their exposure to exchange-traded funds. That's a powerful statement, especially when exchange-traded funds are being embraced with active strategies, in blending type of strategies to increase an advisor's toolbox, increase an investor's toolbox to bring their best foot forward in terms of selecting the investment vehicle that can best help them meet their objectives.
We'll get into some of those issues later. Let's talk about the growth.
Yeah, let me just, I agree with Dodd completely, except I suspect that the next phase of ETF growth will be a little bit different than the first phase. I think the first phase was really filling the major spots on the asset classification board. I think we've done that pretty well. And we've started to see some closures, which we would all argue is a healthy thing for the industry, because not all strategies are terrific and not all strategies really make sense. But I suspect the next wave of growth will really focus on additional product innovation. We've started to see some, and I suspect in our discussion today we'll get into that in greater detail. It will come from more adoption from advisors. You're certainly seeing that in the wirehouse world. You're seeing it in the RIA community. I would also call out that I think there's another growth segment that we all need to be very mindful of, and that is the ETF strategist world, where Morningstar now is tracking the growth of these ETF strategists who are building model portfolios primarily using ETFs, and then making those available to other RIAs, and now starting to get on some of the wirehouse platforms. So I think growth will continue at a rapid rate, but I suspect it will be a little bit different. It'll be different in the sense that we'll demand better product innovation, no more Me Too products. That's already covered. And I think the growth will come from smarter advisors really spending more time to understand the tools that they're using to build portfolios. So I agree with the growth rate, but I think the complexion might be a little bit different in the next phase than what we experienced in the first phase.
David, Martin, any other views on that?
I'd agree with both of them. I think you are going to see increased innovation. I think the easy kind of market access products have been done. It's going to be a question of either better ways to hit certain markets or better ways for portfolio completion. And those kind of products are really going to speak to this ETF model manager and the ETF research houses. And as those guys grow, and they're experiencing phenomenal growth as well, you would expect to see the growth in the ETF market follow that.
Yeah, so I would just add on to that and agree with all of the earlier points. But what's really exciting about the ETF industry is when we begin to think about these segments, either traditional asset class exposure, that still has plenty of room to run, because as those ETFs grow in size and liquidity, we now have a significant greater pool of assets moving towards that in the form of institutional investors, both in the US and outside of the US, who are now coming to these products and bringing further liquidity and assets into the marketplace. Couple that with advances in advanced beta solutions, with alternatives, bringing ETFs to harder to access markets that never existed for advisors or retail investors in a liquid, cost-effective, and transparent fashion. That's quite exciting. And now we're really just in the early stages of active ETFs, with ETFs being accepted as an investment vehicle and tool to access markets in a different fashion than traditional mutual funds, and that they truly, funds and ETFs can really coexist in investor portfolios.
And I want to come back to a point you made, the penetration rate. What is the penetration among investors and among advisors?
Yeah, it's incredibly low. So you look at the US ETP market, including notes and partnerships and the traditional exchange-traded funds, and we're looking at $1.5 trillion. Compare that to the mutual fund market, $10.2 trillion. Compare it to the credit and derivatives net market, we're talking 28 trillion. Compare it to the overall capital markets, which is really what ETFs deliver, a more efficient way of getting a bundled exposures to different segments of the capital markets. I mean, in the US, you're looking at a $40 trillion market in fixed income, you're looking at an $18 trillion market in equities. So penetration rates translated into, say, fixed income, 0.6%. That's what ETFs own in the fixed income market, and that's why at BlackRock we're so bullish for growth in the fixed income market, even though it has been an engine of growth over the last few years. On the equity side, it's a 6% penetration rate. You compare that to almost any other vehicles, and it's not just versus mutual funds. It's an alternative and a better way of getting exposure versus all those other investment vehicles we talked about. Equity market, we're just at 6%, 7% of overall assets.
So let's get to one issue is when, in terms of penetration, what should it replace? What should ETFs replace, or to what degree? And where do they fit better than a traditional product might, whether it's a mutual fund or something else, given the new strategies that are coming out?
I think historically what we've seen is a lot of the growth has come at the expense of mutual funds who haven't been able to deliver the excess returns. And that I think has been a big catalyst for the early growth. We're certainly not predicting that mutual funds go away, but I think that will continue to be a source of growth going forward. But I think just focusing on the advisor community, if you think of the evolution of an advisor, an advisor might have begun in the business buying individual stocks, and then they kind of grew up, and ETFs have become the best raw materials to reflect their asset allocation views, whether they're views coming from the firm or they're a strategist where they're developing it on their own. So I think some of the growth is organic just because there's better materials which allows more flexibility in accessing markets they weren't able to access in the past. Some of it will come at the expense of mutual funds, and for those who are predicting the demise of mutual funds, we're certainly not predicting that's the case. But I think it's interesting as you've started to see a lot of the big mutual fund companies saying, I too want to offer ETFs. So there's going to be a blurring of the lines, and I know Dave mentioned active ETFs. So I think you'll see a blurring of the lines, and ETF is really a packaging mechanism, but it's a packaging that I think a lot of advisors have embraced because it's easy to build portfolios and get exposure to inefficient markets.
Yeah, I think there's a certain amount of cyclicality that's helped here as correlations between individual equities have really increased. The old art of stock picking has kind of gone a little bit out of fashion, and so there's been a lot of talk about the growth of passive and how it's displacing active, and I think that's maybe a little bit not probably the best way of describing it. It's really that active management has kind of moved up a level in terms of it's become an asset allocation strategy, or it's become a sector rotation strategy as advisors and investors are moving away from picking individual stocks, and they're now trying to build portfolios, and they're now using ETFs to kind of put those building blocks together. And oftentimes they're using them alongside mutual funds, they're using them alongside structured notes, they're using them alongside alternatives and other hedge funds in kind of a barbell approach. I think where the ETF really fits in, it's such a versatile product. You can put it in any portfolio, and it seems to fit alongside most other types of wrappers. And so it's just a very simple tool to get access to a market when you don't think there's a certain manager that can give you that alpha. You just want the most efficient, easy-to-use beta, and that's where a lot of ETFs have really delivered.
Yeah. David, any thoughts on that?
Yeah, so the only thing I'd add on to that is, to further one of Dodd's earlier points is when you say almost 98% of advisors are looking to add ETFs to portfolios, the penetration rate in portfolios is actually only 7% right now. Mm-hmm. So if we even think about that on an incremental basis, just that growth rate from moving from 7% to 8% is going to drive a significant amount of flows into the industry. But it all goes back to the toolkit that advisors and other investors can now have, in that it's not necessarily a discrete decision between I need to be active in one space or passive here. It's understanding what vehicle is going to meet my particular clients or my investment needs to allow me to build a portfolio that's resilient to a variety of different market environments and resilient to the liquidity needs that my particular client may have.
So in your discussion with investors and advisors, what's the one key thing you find that's keeping them from using ETFs, and what don't they understand that sort of the impediment to them using ETFs more fully?
I think, as we were talking earlier, I think there is a bit of a learning curve. I think a lot of advisors have embraced ETFs without really understanding what's going on under the hood. I think trading liquidity is a common thing that I suspect we all hear an awful lot about. People really don't understand the trading liquidity of ETFs, and they shy away from it because they're concerned if they buy it, they can't get out of it. But I think there's a lot of education that needs to be done, and I think all of our roles, first and foremost, are really educating consumers about what it is you're getting exposure to, how to use it in portfolios, and I think we're all saying a lot of similar things, which is it's not necessarily a replacement for active, it's really how do you combine your active and your passive strategies. And I think there's a lot of education in getting people comfortable with that. I think the average advisor understands what an ETF brings to them, but they probably haven't taken the necessary step of peeling back the onion to understand what types of exposure you have in those various strategies.
And Deb, what have you found? What's missing?
I think it's a lot about awareness, to be honest, and education. I completely agree with what Tony said, and especially for the group of investors that haven't used ETFs yet. The 7% in the financial advisor market. I mean, we all talk about how big ETFs are in the RIA community. Mm-hmm. The book of business or share of wallet there for ETFs is only 13%. So I mean, a lot bigger than 7, but there's a lot of runway for growth. So there are a lot of folks that are not using these yet, and what we're finding more often than not, as that Cerulli number shows, is when people try ETFs and they begin to use them in their portfolios as a complement to other types of strategies and investment vehicles, they like what they see, and they start to use more. And we're in the beginning stages of that.
So without getting too much into the details of how they actually work, but I'd like to raise one issue. There's the ETF itself is always liquid. I mean, that'll trade. It's the components underneath that sometimes are different, right? I mean, so give me and everyone else sort of a fast lesson in what's the difference between the wrapper and what's the components of what's in the ETF and the liquidity of those two things. But they're two different issues, correct?
I think ultimately the liquidity of an ETF is driven by the liquidity of the least liquid underlier within the basket that it's holding. So say you're buying a Japanese equity ETF. Really the liquidity of that ETF is, in theory, is going to be what is the least liquid Japanese stock in that basket. However, you also have to concern yourself with what is the actual trading market, the secondary market of that ETF looking like, because not all investors can trade in creation unit size.
Explain what that is.
So a creation unit is the minimum size that the fund will accept as a creation or redemption, as in money coming in or money going out. For a lot of ETFs, it's 50,000 share blocks. Depending on the share price,
so institutional traders can trade that size, but
it's an institutional size effectively. Although right. It's small enough that a lot of RIAs can do it, but for retail investors or smaller advisors, they may not be able to do that. And so a very simple rule for them is, either try and trade when the underlying market is open. In the case of a Japanese equity product, that's not going to be possible. So you want to look to use limit orders. And we always, even in our most liquid products, we will tell investors to use limit orders, simply because that way, if the market blows out for some reason, if you're buying in maybe a less liquid, newer product, you're protecting yourself from just being executed whatever the market blows out to. And that's one of the things I think that we've been, all of us here have been kind of out on the road trying to tell that story, and we need to do it more, and we need to continue doing that.
And that goes back to the earlier point on education. That's a big difference that ETFs have relative to funds or to individual securities, because there's multiple layers of liquidity. You have the secondary market, which is most transparent to many investors, because that's what you normally can see on screen. But what Martin's alluding to is that there's a primary market that exists for ETFs as well, where there actually is transactions occurring between market makers and the ETF sponsor. And in that case, investors do need to understand and be aware of exactly what the ETF is holding, because many people became most familiar with equity ETFs, for example, because those are the first ones.
And those are the large cap stocks.
And those are large caps, and those are very liquid stocks and very easy for many people to understand because they're following them through the multiple mechanisms that they can. But now ETFs have moved into less liquid markets, really brought liquidity and price discovery to those marketplaces, but that adds an additional layer of due diligence and understanding that the advisor and other investor community is really just beginning to pick up on now.
And how would advisors know what's liquid and illiquid, aside from assuming that the smaller ones are probably, or the more obscure ones like maybe less liquid? How would you know?
You have to, as Tony said, you got to peel back the onion. You got to look under the hood of the product to see what's in it. You can't buy a product based on what the sales pitch is or what the name of the product is. And I think in the past, some people have been guilty of doing it. I think it is incumbent on you. It's your money, right, or it's your client's money. You actually have to do the due diligence and make sure you understand the product. It may be simple to execute. It shouldn't necessarily mean it's simple for you to kind of figure out the product, right? You do need to do the work.
Yeah, understanding the T in ETFs is so important, and people overlook that. And that's the biggest pitfall that we often find. And I think where we're spending most of our time educating. But in the secondary market alone, ETFs can be not liquid at all, liquid and uber liquid, and depending on where they fall in those general categories, can really drive the way an individual investor or financial advisor is going to enter their order and think about trading. I mean, the non-liquid stuff, if it offers a differentiated exposure that's compelling and meets your objectives, there's no reason not to invest in that. On the other side of the coin, the uber liquid stuff, you can get pricing efficiency that actually gives you better execution, cheaper execution, than if you had the size, scale, and ability to hit a button, issue a program trade, and buy all of the underlying stocks. Think about the emerging markets, MSCI Emerging Markets Index. There's several ETFs based upon that. You can get done with the iShares Emerging Markets product at a penny wide throughout the day. To buy that basket of stocks is 16, 17 basis points. So. Yeah.
And so the entire burden isn't on the advisor themselves. I think we would all recommend that if somebody was looking to buy in meaningful size, reach out to the ETF providers, because the ETF providers can help with explaining the liquidity and best practices in trading and all of that, and helping to even source liquidity in the marketplace. So I think that's been one of the impediments that a lot of the wirehouse advisors, maybe they're putting in an order, they have a bad experience, and they think it really doesn't trade the way that it's supposed to. And I would just say leverage those who are in the industry, one, to provide education, but two, to help walk through that process. If you've gone through the process of unveiling and peeling back that onion, and you've made a determination, I know which strategy I want to get exposure to, leverage the providers to help make that happen.
And I guess, of course, it's worth making the point that sometimes illiquidity isn't necessarily bad. If someone's buying something for a long-term portfolio holding, I mean, what difference does it make if you don't buy it this second or the next second, right?
It's something, if you're comfortable with getting into these less liquid markets, you're going to have to deal with. And I think through the process of really understanding, you should take that into consideration. So if I'm getting into the emerging markets, you need to think about when you want to trade it, because you want to trade it when it's open. And you need to think about the fact that there probably is less liquidity. So if you're buying it on a short run basis, you're going to think of it differently than if you're buying it and you're going to hold it for an extended period of time.
But since we're on the subject of liquidity, let's talk a little bit about ETFs in the fixed income market, because they've grown a lot, but there are also issues of liquidity there. How are they different from equity ETFs?
Can I start with the basic? And I know Dod's going to want to jump in, because I know you guys have done a lot of work here, but fixed income ETFs, first of all, are relatively new. And the reason they're relatively new is if I wanted to buy the S&P 500, regardless of the weighting mechanism, I could do that very easily today. There's 500 names, and all I have to do is determine the weight, and I go out and I buy a basket of them. when you're buying in the fixed income market, that's not the same world. You're not buying the Barclays Ag. You're not buying the basket of 1,000 underlying bonds. So I think part of the reason that fixed income was a little slow in coming to the market and iShares was very early in this was you needed to figure out how you're actually going to buy a basket of bonds, and the basket you buy tomorrow as more flows come in isn't necessarily the basket that you bought initially. So there's some sampling that goes on in the fixed income market. So I would argue that the firms that have been successful in offering fixed income ETFs are actually in the fixed income market. You've got to be aware of the market because there is some element of active that goes into everything that goes on. And it's not surprising, to me at least, that you see a lot of active fixed income strategies in the short end and in the long end, because I think it's conducive and it makes sense there. And as much as Bill Gross can give you his holdings every day, the average person can't copy that trade, right? It's an institutional market. It's very different. And Todd, I know you're kind of passionate about this, so.
Yeah, we've done a lot of work on that. We have a forecast globally that we think fixed income exchange traded products are going to be $2 trillion in the next 10 years. I know that's a big number. That's the size of the global market today. So,
and you're looking to account for about 3/4 of that, right?
Not if we can do anything about it. Yeah.
But the thing behind that really is, what ETFs bring to the table. We think that ETFs in the fixed income space are not changing the asset management industry. They're changing the capital markets and the way people access fixed income. If you think about what ETFs have done, is they've brought in the fixed income market, which is over the counter, which is typically opaque, it's inefficient, it's a negotiated market, right? When you want to buy a bond, you pick up a phone, you talk to another person. There's no tape and competitive market out there. It's porting an over the counter market with arguably some efficiencies, maybe some very big efficiencies, and bringing it onto an equity exchange, which is transparent, which is very competitive, and it allows individuals to access the same type of economic exposures in a diversified, precise way, in a far more efficient way than they ever were before. So that, to me, it really explains why we've seen such growth. It's gone from 5% of the ETF market in 2005 to now 17%. I think the other thing behind the growth that we're seeing is a diversity of exposures. And there's been a lot of talk of this great rotation out of fixed income into equities. We haven't seen that in the ETF space in particular, because of the diverse exposures that they can offer. So if you look at flows year to date, $26 billion has gone into short-term, floating rate, and bank loan. If you look at the rest of the maturity buckets, they actually have had negative flows of over $6 billion. So to us, be able to, for an investor, for an advisor to position a portfolio precisely in efficiency with ETFs in virtually any economic environment, to get their fixed income exposure is really compelling.
And that's what I think is quite exciting about the opportunity set that ETFs, and particularly fixed income ETFs, offer in general. Certainly there is a learning curve, an educational component that we all touched on. But to Dodd's point, when you think about the ability to construct portfolios today, using almost entirely ETFs, you can now build portfolios that are covering multiple market caps within the equity space, multiple geographies. In fixed income, now you no longer need to think about your fixed income exposure as a bolt-on to your equities, as just something to reduce maybe your volatility that you have from equities. You can really build precise exposures across the treasury spectrum, across corporate and credit exposures, all the way up and down from investment grade to high yield within both fixed rate and floating rate, coupled in with the exposure that you can get with international emerging markets. So you can build very, very diverse portfolios to meet any particular investment need via ETFs. And that's why we believe as well that there's going to be continued amount of interest within fixed income ETFs and ETFs in general because of that.
And it's not just individuals that get the benefit from this efficiency. We're seeing a lot more institutions using fixed income ETFs because it's just a lot easier for them to get that basket by going out into the equity market and buying it as an ETF than to go and source all of the bonds that are in the basket individually. And if everybody's looking to cut expenses these days, if there's a choice between having a full-on bond trading desk or having your a few bond traders on your equity desk, helping them to execute the ETF, it doesn't take too much thinking about to make that decision. And so I think that's where you're going to see more and more growth in the ETF space, and a lot more of the institutional investors we've spoken to are getting more and more interested in the fixed income ETFs.
Well, Martin, you mentioned cost. I mean, obviously in the beginning, one of the advantages of ETFs was that less expensive structure than mutual funds. But when you get into these more esoteric kinds of ETFs, obviously the costs seem to go up. Where are costs going in ETFs, and how important are they?
Well, I don't think costs are really going up. I think the harder to access asset classes, and the ones where the execution of the ETF make a difference and where you can actually differentiate yourself, you've seen probably higher fees than you have in the large cap US equity or kind of very, very simple bond products. But broadly we've seen costs come down. But you've got to look at costs in more than one way, and the tax efficiency of the ETF wrapper more than offsets a lot of the costs that you may have from actually buying it from a management fee. And the liquidity that you can get, from buying the ETF, at a penny wide rather than going out and sourcing all the bonds or all the underlying equities for much wider, those can actually translate into much, much more efficiency. And then the final thing is, you've got an equity portfolio and then you've got fixed income ETFs. Well, you can cross margin those, right? That means that you're being much more efficient with your capital. And so, all in all, there's more than just a management fee when it comes down to what the efficiencies are for the investor.
Any other comments on costs?
I think cost is a consideration. I think, as Martin said, it's one of the considerations. And when you think about cost, you need to think of the totality of cost. I think cost will come down, but it's not going to go to free. I think certain strategies deserve and warrant a premium. But I'd argue, if we're looking ETFs across ETFs, that's one comparison, but ETFs by and large are still much more cost effective than mutual funds or SMAs or buying individual bonds on your own. So I think they still provide that great cost advantage. But I think the more, you say esoteric, but more evolved sort of strategies are going to have a slightly higher fee. I think that's the nature of the beast. They're more expensive to manage. You potentially have discovery sort of issues and higher turnover, more cost, more portfolio management. But I think it more than warrants the additional cost.
But with ETFs in particular, it's very important to think about that total cost of ownership that you alluded to, because we know we have the headline expense ratio. And that's certainly what much of the focus has been on. And I think that's driven a lot of money towards ETFs in general because they are lower cost than other offerings. But this goes back to the educational component as well, because we need to think about what is the tracking error of the strategy. That's a part of your total cost. What is the bid-ask spread? What is the volatility of that bid-ask spread when it comes down for you to actually execute on it? What commissions are you going to pay? Think about it from that total perspective, and then you're going to have a better understanding of exactly what that cost over the long run is to own that particular product. And then I think that will also further help with the people becoming continued more comfortable with ETFs, that it's not just one number versus another. Think about it from that perspective and really understand the benefits that they can bring to your portfolio.
You mentioned tracking error. First explain that a little bit, and then what is the problem if there is tracking error?
So tracking error is a concept that many investors focus on, particularly within passive management in general, and even within active management. It's taking a look at what is generally in the ETF space, purely what is the difference between the return of the fund versus the return of the benchmark. But with ETFs, you also have the return of the fund from a net asset value perspective, but also from the market price perspective. So there's a few different levers and layers to consider. So investors do want to have an understanding of how is that ETF from a passive management perspective providing that exposure over a different time period in line with the index that you would come expect. In certain markets, investors may need to be comfortable with having a little bit slightly higher tracking error, maybe parts of the fixed income market, so you have that liquidity. So it's really, I think, about the balance between being a completely liquid product on one end, which may have huge tracking error, versus a product that tracks perfectly that doesn't allow much liquidity. Mm-hmm. So one of the things from a portfolio management perspective is, at State Street, we try to balance some of that. But from an investor standpoint, looking at that, you need to understand that there are trade-offs that need to be made from that perspective.
There are two types of tracking error. One is tracking relative to your own index. And I think Dave's right, you want to have tight tracking relative to your own index. But as we think of these more evolved strategies and alternative beta strategies, which we were talking about earlier, there will be a tracking error. And a lot of people would say, well, these alternative beta strategies are different than the market because you're reweighting portfolios, you're using some logic to design the portfolio construction, and you're going to have tracking error relative to the market, whatever you deem the market to be. to me, that's a healthy tracking error. And to me, it's really important to make the distinction between the tracking error that you really want, which is tracking error relative to your own benchmark, as opposed to tracking error relative to another benchmark. And to me, the tracking error there, the question becomes not that you're different, because you expect to be different because you're reweighting portfolios in a different manner. The question there is, are you rewarded for being different? Right? And if you're rewarded for being different in the form of alpha or a better information ratio or Sharpe ratio, I think you're more than warranted for being different. And I think in the industry, those two types of tracking are sometimes interchanged, and people kind of miss the point of that.
Let's talk about this issue of smart beta, or alternative beta, or the British call smart beta. I've heard that on. What is that anyway? So what is it in plain English and American, smart beta? What are we talking about?
So I'll give the kind of the overall view of it. You know, if the market is beta, smart beta or alternative beta in its simplest form are looking at different ways of owning that market. Same basket of stocks, either reweighting it. The traditional ways that you think about that are equal weight, taking the same 500 stocks that are in their S&P, and rather than market cap weighted, where the largest names have the largest weight in the underlying index, essentially making a bet on the biggest companies being the best companies. Equal weight spreads the risk evenly, and each name has an equal contribution of return over time. That's one area. The most common, and where I think there's a lot of academic research supporting this, are fundamentally weighted strategies. And fundamentally weighted strategies attempt to apply logic into how do I weight a security. Again, rather than arbitrarily weight a security based on the biggest names having the biggest weight in the underlying index, screening and weighting securities by factors. And there are different sort of factors that the providers use, but using those factors to develop a portfolio that has different characteristics over time. And based on the research done by Rob Arnott, who is really the pioneer in developing fundamental strategies, or EdHec, or Cass, and there's a whole slew of people who have done a lot of research in this area. These alternative weighting strategies and fundamental strategies in particular have historically delivered significant excess returns. So that's part of the appeal, and that's why people have gravitated to these sort of strategies. I think they're very interesting. We've done a tremendous amount of research on them. I think they're definitely something that warrant attention in a portfolio, but maybe unlike other folks that spend a lot of time thinking about this, we actually view them as a complement to a market cap portfolio, because the market cap portfolio gives you the beta, the market, the way that it's comprised, the typical sort of benchmark. We understand there are bets that are made. You're going to overweight the largest names, and you're going to potentially have a little bit of growth bias. And then fundamental strategies tend to have a little bit more of a value bias. So we actually look at the two of them as complements to one another, and based on the research that we've done, what you do is you take out the peaks and the valleys over time. So although you get a little bit more alpha out of the one strategy, you do have higher tracking error. So there are trade-offs along the way.
Let's hear from some of the providers.
I think alternative beta can be described as either different weightings, whether it's equal weighted or fundamental. I think it's also other ways of providing exposures, whether it's hedging out a risk factor, or whether it's saying commodities using a different roll methodology in order to differentiate from the standard benchmarks in the space. Really what it is taking a look at what are the standard ways of accessing an asset class, and seeing if there's a better way to do it, or there's a way that fits better with a certain view or a certain market environment. And ultimately, it's giving the investor more choice and more flexibility as to how they want to build their portfolio. And that's really hopefully the end game that we get to with these alternative beta or smart beta strategies.
I agree, more choices.
And what does Deutsche do with hedging? Do you have
so we have a series of exchange-traded funds, a suite of them, that track MSCI benchmark equity indices, international equities, and then we overlay a currency hedge on them. For example, the big trade this year so far has been Japan with a currency hedge. You know, Japanese equities have done really, really well, but the yen has devalued pretty significantly. I think the difference between having a hedged basket and an unhedged basket has been about 20% year to date. And so by offering the hedged counterparts to the unhedged products that are already out there in the marketplace, we're giving investors a choice to make. Now they can actively decide whether or not they want that currency exposure. If they think that the dollar is going to decline and foreign currencies are actually undervalued, they want to stay unhedged. If they don't have a viewpoint, maybe they go 50-50. But if they believe the dollar is going to strengthen, as a lot of FX forecasters are predicting, then they maybe want to look to hedge some or all of that exposure using a hedged product.
Dave? Sorry, do you want to talk about something?
I think this gets back to kind of our awareness thing too. You know, one of the things that we find is you talk to a lot of investors and they think about ETFs as just being passive. just being market cap, and they're missing a lot of the innovation. I mean, if you think there's been a lot of innovation in growth in ETFs, think about the indexing industry as well. And we've seen tremendous amount of innovation in terms of new indexes, new types of strategies that ETFs can be based upon that are really resonating. I think the characteristics of what's worked this year are transparent, they're rules-based, it's an exposure that's different than market cap, but it's one that can actually be explained by investors of meeting a specific objective or type of strategy. It's a growing part of the market. So if you look at non-market cap weighted ETFs just on the equity side of the ledger, it accounts for about 16% of assets. Yet year to date, we've seen 44% of net inflows. And keep in mind, it's a record year of inflows, or on pace for a record year, are going into non-market cap weighted ETFs. It doesn't mean that the market cap weighted ones have anything wrong with that. And we firmly believe those core products are going to continue to grow with investor adoption. But innovation has certainly not stopped, and we're seeing that with these cool products, currency hedged, strategy-based. Minimum volatility has been an area that's grown a lot. It's gone from $7 billion to $14 billion. Minimum volatility is trying to give exposure to an equity market, currently equity markets, but doing so by creating a lower volatility type of portfolio, not just looking and selecting the low vol stocks within, say, the the S&P 500, for example, but creating a portfolio with low covariance between the different, an optimal covariance between the portfolios. So it's looking for, essentially a lot of investors think of upside downside capture, trying to create an attractive upside downside capture using the component opportunity set of stocks. Dividend weighted is also one that has grown really big. $15 billion has gone into that area alone this year. It's $86 billion is in dividend weighted or dividend type ETFs. And I think that, again, meets the needs of what investors are looking for, is a different type of exposure.
And I was just going to add, we talked earlier about institutional demand, and a lot of it, what's really exciting is the institutions are demanding, I want exposure to these markets, but I want it in a different way. And actually what's great is, we're at this great inflection point where the institutional demand and the academic research is really causing the index providers to come up with those innovative solutions. So the win-win is the individual investor is actually getting exposure to the best ideas, packaged in an easy to understand and explainable format.
Yeah, this is about an evolution, actually, of the investment industry, which the ETF vehicle is a microcosm of that. Because there are many, many strategies that exist out there on the institutional side that are now moving into the ETF space, as you mentioned, because institutions are now looking at portfolios very differently. They're actually decomposing equity market returns and understanding what actually factors, as you allude to, are premiums. So what is the market reward over the long run? Maybe it's a size effect, maybe it's a value effect, or maybe something about volatility that I can harness. If you can build that or construct that in an ETF vehicle, do it at a low cost, which you can do because many of them are index-based, and then make that a liquid vehicle that investors can then use to build more precise exposures to say, I have a client, for example, that really wants equity market exposure. But actually, when I think about it, what they really want is a higher dividend yield than you can get with the S&P. So maybe I'll go with a dividend yield weighted strategy. And then I have another client who really is concerned about their volatility profile. They have a lot of fixed income right now, but I know they need some growth. I don't want to go and necessarily buy the entire equity market. You can use that with a low volatility strategy.
Let me ask a question behind the closed doors of the product companies. Do you sit around thinking, let's try this and see if this works? Or do the institutions come to you and say, would you make this for me? And how does it, or is it both?
From our perspective, most of our best ideas or ETFs ideas are really client driven. So we don't necessarily just want to create a product because I personally think it's going to be a great idea. Most of my ideas are probably too crazy to ever put out into an ETF form. So our product development team throws those out right away whenever I submit them. But a lot of it comes from when we're meeting with institutions or meeting with advisors and going around and hearing the needs that they have, hearing what are the challenges that they really want to that they're facing, and trying to help devise ETF strategies, working with our partners on the index provider side to then deliver those to clients.
Go ahead, Morten.
I'll say it's very, very similar. I mean, the one kind of difference that I have sitting within a larger bank is that every now and again I'll go and ask the traders what they see their clients doing and kind of what they think is driving flows, what they think is the kind of the genesis of a lot of the trades that they're seeing going on. which can be quite useful in terms of product development.
Because it seems, not too distant past, some of the criticism was that the product providers are coming up with these ETFs where there's really no economic need, and it's just kind of trying to capture something. And now it seems like it's more bespoke in a certain way, like you're responding to certain demands from the market, saying, make me this thing.
Hence the comment earlier about some strategies closing. They weren't relevant. They weren't really unique and differentiated in the marketplace. I don't sit on the manufacturing side of our business, but I can tell you in a past life, let's not discount the index providers who would come in and say, our institutional clients are asking for these sort of strategies. Would this be of interest to you? So, again, I agree with Dave. I think it's a really exciting time to be in this industry because we're getting a lot of this innovation, and I think we're able to respond to, one, a changing market environment, but two, the demands that are coming from the clients are very different today. It's not just I want to get exposure to the S&P or the broad-based market. I want exposure to the market that looks like this or protects on the downside or positions me this way because I've got other parts of my portfolio that are doing something different. So we're really at a great point in time, and this innovation flows through to the individual investor.
Yeah, I think the market's pretty unforgiving, and if there's no economic need for a product, it doesn't last that long.
Yeah.
So we were talking about many of these comments for the institutional market. They want a certain product that does a certain thing. Let's go back to the retail market and advisors and portfolio allocation issues. And how do they decide what product to pick or what replaces what? For example, we're talking about fixed income ETFs. How much should a fixed income ETF replace either a fixed income mutual fund or direct holdings of bonds? Where does it fit? Like, how do you help them figure out what to do in terms of portfolio allocation?
I just finished a white paper on a more evolved view on asset allocation and portfolio construction precisely for that reason, because I think a lot of times product providers come in and say, buy my strategy, whether it's a fund or an ETF, without answering the question that the client has, which is, well, how do I use it? And it's not active versus passive. So we go through kind of some of the academic research and kind of the evolution of modern portfolio theory, but at the end what we're suggesting to the average investor is we'll give you kind of our recommendations on how to think about employing active market cap and fundamental strategies, but more importantly we're giving them the lever to say, based on your sensitivity to these factors, you can actually toggle and overweight or underweight these factors. If you've given up the pursuit of ever finding active managers, that's not going to be part of your equation, and then you're going to think about how I get my passive exposure. The one thing we haven't talked about, which I think is relevant, is we all love these index-based strategies because they have rules and they follow them. But what happens if there's an exogenous event or something happens that causes you to take a more defensive posture? These strategies can't do a lot. You can have strategies that are more defensive in nature, but they can't alter their strategy because they're rules-based. To me, part of the value of an active manager that sometimes we underestimate is the ability to stop, absorb the information, alter your strategy, either get more defensive or actually pull back and sit on cash. So to us, the way that we think about it is that is an important component when you think about the active manager. If you can identify managers that are delivering good returns, but more importantly do a better job protecting on the downside, that's why I would marry them with a passive strategy. And I think that's something that sometimes the individual investor doesn't think about until it's too late.
I think this implementation dilemma is really what's been driving the growth of these all ETF model managers. And here you've got that active manager who can put their foot on the brake and say, all right, out of the market, or we're moving defensive, and still using these very, very liquid building blocks. In the end, a decision has to be made about an investment. And if you've moved it away from individual stocks, you are now making decisions about markets to be in, or sectors to be in, overweights, underweights. And at that point, someone's got to make. There's got to be at some point a human making a decision, unless you're doing a full algo, and then a human had to build it, right? Until we get algos building algos, it's probably being done, but I'm not smart enough to know about it. The fact of the matter is, there is going to be a manager somewhere, and whether it's the advisor or whether they outsource that to one of these third-party managers, and that's really where we've seen a lot of the growth, I think, in that third-party manager group.
The number of ETFs plus compounded with the number of funds and other offerings, it's a blessing and a curse. Right, so as ETFs have grown and their size and liquidity has increased at the same time, it's made the buying decision for investors more difficult. So one of the things that we've put together, for example, is an ETF due diligence checklist, which is a way across a variety of different mechanisms for advisors or retail investors to really take take a look and look under the hood, for example, across all of those different mechanisms, whether it's ranging from the fund provider to the index provider to the strategies that are being employed underneath that, because we've really, with ETFs, we've really moved from the ability to purely think about a stock selection, for example, or individual security selection for that matter, and whether or not you're utilizing, outsourcing that to a third-party manager, or you're doing it yourself as an advisor or a retail investor, you can build fully diverse, well-constructed portfolios with ETFs, and that's really what the question becomes. It's no longer, well, that's a really, really cool strategy, I think I'm just going to buy it. It's, well, how much am I going to sell of this to buy that? Or what ratio relative to this do I want to weight that? And so I think that's a very, very healthy component that, in some sense, ETFs have really been on the forefront of bringing to the retail and advisory community.
And do you provide that kind of information to the users of SSGA funds?
Yeah, so one of the things that we've really have done here is really at State Street at SSGA is begun to embrace that to more effectively. It's when we launch a new product, we're no longer just sort of announcing it or putting a white paper or case for about it from simply the perspective of why, again, is this fund great in isolation. We usually take a step back and build some dummy model portfolios, which may not fit everyone's portfolio, but just a general sense to say, if I were to move some money away from this particular exposure, if it's an investment grade and I want to move to a short duration high yield product, what exactly would that look like if I moved from one particular way to going into that way? So we're definitely attempting and trying to bring that to advisors and other investors so they can fully understand how to use them.
And what about at BlackRock?
One of our big initiatives is putting together model portfolios. So for that area of advisor kind of in the middle of what we've talked about, I mean, taking a step back, you've got some do-it-yourselfers that have a view on the markets, that think from a macro top-down perspective, think from an asset allocation perspective, and ETFs are a no-brainer for them. They're precise ways, building blocks to, whether it's a sector rotation or a long-term strategic allocation, they just fit perfect with those type of strategies. On the other end, you got people that want to totally outsource to another manager, whether it's these third-party managers that are growing at a huge clip, of over 60% over the last year. Then you got folks in the middle that are just looking for guidance. They're looking for guardrails or advice in terms of how do I think about building a model portfolio and what does it look from a longer-term risk-return perspective. So we are publishing those, think of it as a paper type of portfolio that advisors can either follow directly or they can use that as a starting point to say, well, you know, I don't feel that comfortable with 25% in emerging markets. I'm going to scale that down. I'm going to scale up my U.S. equity exposure. So I think it's all about advice, and that's more the wealth management process. On the other side of the coin, I mean, due diligence, I think, is incredibly important around ETFs, and so many people forget about that, too. Again, it's overgeneralizing and thinking about our industry being commoditized, which I think we'll all agree is not. I mean, there's a lot of daylight between the 30-plus products that give large cap exposure, even from a risk-return perspective. So, you know, being able to offer folks the insight in terms of what to look at when selecting among the many choices within an ETF is incredibly important as well. And I would argue it's as important as the due diligence process that people put on the active side, but often it's ignored, and that's where people fall in the pitfalls of things we've talked about today. Yeah. You know, not considering trading, not considering the differences in exposure, not thinking about total cost and looking at expense ratio and calling it a day. It's a nuanced market. It's a transparent, straightforward one, but one that you really do need to put your homework in and either outsource or do yourself.
One of the things I mentioned earlier was our alternative investment conference, and in the conference we will be discussing use of ETFs to access alternative strategies, alternative asset classes. What's your view on that? Is that growing? Is ETFs provide, what advantage do they provide in accessing alternative strategies and asset classes and vehicle? Well, they are the vehicle, but where do alternatives fit with ETFs?
So, I mean, our largest product is a commodities ETF. It was the first of its kind. And what it offered to the market at the time was it was lower cost than the mutual fund products that were out there in that space. It was cheaper. You know, overall, not just lower cost, it had a lower tax rate, blended tax rate on it. And also it was transparent, right? You could see what was in it on any given day. We weren't doing anything with the collateral. And so that low cost and that transparency got investors in. After 2008, we had a huge flood of money come in over 2009 from a lot of private banks that have been using managed futures funds and other products that had offered or claimed to offer daily liquidity. And then when they tried to get the money out in the dog days of '08, they got gated. And they knew that, from the ETF structure, we couldn't gate them, right? Up until you're down to your last creation, you have to accept that redemption. And so they found it to be a much safer way to get access to the commodity space. And we've seen that's one of the things that the ETF has brought to a lot of asset classes, is to kind of democratize them, but also bring that transparency, right? Sunlight is the best disinfectant. And if you have these very, very transparent tools, I often say to people that want to use, an active manager in the commodity space, I say, oh, that's fine, that's your decision. Please benchmark them versus my fund rather than the benchmarks. That's all I ask, right? At least make them earn the extra money you're paying them for that alpha. I really think they do offer something in the alternative space.
But I would say that to date, most of the growth has been in commodities and currencies in the alternative space. There are some structural limitations, and I would always be careful to say, you have a great idea, does it translate well into a structure? You have to understand some of the limitations in the ETF structure, primarily the ability to be long and short, and we haven't really seen a flood of broad-based alternative strategies. There's some in the market. There's managed future strategies. My past firm, we had developed some strategies. So I would just say you need to be careful. Do they translate well? Do they deliver on the promise of alternatives overall? And if it doesn't work in that wrapper, that's fine. There are other ways of doing it. You see the growth in the liquid alternative strategies, and that's a byproduct to say it gives you certain features that you don't get with an LP structure. So I think we're still early, and I think the jury's out whether they all translate well. Commodities and currencies, I think, have worked well. Some of the other ones not as well.
Well, in terms of this masterclass, we're not so early anymore. We're getting to the top, so I wanted to get takeaways from each of you. Kind of the pithiest elevator speech you can think of, 5 seconds, 10 seconds, as to what advisors and other investors should be looking for in ETFs, what the takeaway should be. So we started with Dodd first. Give him a break. We'll start with you, Ty.
God, I'm not really big on pithy. I would just say it's a really exciting time to be in the ETF industry, but take the time, peel back the onion, understand what you own and understand how you own it.
Martin.
I'd agree with that. I think you really need to look at the strategy. I think, as a rule of thumb, if you look at the strategy and think you could probably replicate it yourself, but it would take too much time away from the rest of your portfolio, then that means it's probably an ETF that's going to do mostly what you think it's going to do.
David?
I'd just add to that and just say, take advantage of all the ETF opportunities that exist out there. But again, do your homework and really leverage the fact that ETFs are transparent. Go to providers' websites. Use the tools that they offer to either do some screening or to just learn more about the portfolio management style or index methodology that's there, and then use other tools that are available oftentimes for free out there that are now focused on the ETF industry.
And Dodd, you had the first word. We have the last word.
Thank you. ETFs are democratizing the way people invest, and the reason why we've seen so much growth is very simple. It's the benefits that they offer. It's transparency we talked about. It's the precision that they can offer exposures to different parts of the market. It's the tax efficiency. It's the liquidity. It's those basic things. I think sometimes people lose the forest for the trees and get caught up in a lot of the nuances we talked about. And while they're very important, don't overlook the industry, because vis-a-vis other products, ETFs are really changing the way people invest.
Well, gentlemen, thank you very much. And I look forward to seeing you all on our next masterclass. Thank you.